Here's a mind-blowing stat that'll make you question everything. Bitcoin has outperformed every major asset class over the past decade on a risk-adjusted basis. Yeah, you heard that right. Gold, stocks, bonds, real estate. Bitcoin beats them all when you measure what actually matters. So why is your financial advisor still treating it like radioactive waste? Because 95% of people, including the so-called experts managing trillions in assets, are measuring Bitcoin's risk completely backward. And if you're one of them, you're leaving generational wealth on the table. Stick around because what I'm about to show you will flip your entire understanding of risk upside down. Quick heads up, this is for educational and entertainment purposes only, not financial advice. Do your own research, folks, and consult a pro before making moves. All right, let's talk about why Wall Street is having an absolute meltdown over Bitcoin while simultaneously ignoring it. It's like watching someone refuse to get in the pool because they're afraid of getting wet, while their house is literally on fire behind them. The irony is delicious, and I'm here for it. So here's the deal. Traditional finance has this golden child metric called the Sharpe ratio. William Sharpe cooked this up back in 1966, and Wall Street has been obsessed with it ever since. Think of it as the ultimate scorecard for investments. It measures how much return you're getting for every unit of risk you're taking. The higher your Sharpe ratio, the better your investment looks on paper. It's like getting paid more per hour, but for your money instead of your time. Here's how it works in stupid simple terms. You take your investment's returns, subtract what you'd make on something safe like a treasury bond, then divide that by how much the investment bounces around. That bouncing, that's volatility. And here's where things get spicy. Wall Street treats volatility like it's the devil himself. But here's Bitcoin's Sharpe ratio compared to the big dogs: gold, bonds, the S&P 500, real estate. Over the last 14 years, Bitcoin has consistently smoked all of them. Not by a little, by a lot. It's not even close. Bitcoin's risk-adjusted returns make everything else look like you're playing in the kiddie pool, while Bitcoin's out here surfing tsunamis and somehow making it look easy. So naturally, every financial advisor in America is recommending massive Bitcoin allocations, right? Wrong. Bank of America's latest Global Fund Manager survey from October 2025 shows the average Bitcoin allocation is now up to 8%. 8%. And 52% still hold exactly zero. Zilch. Nada. Not a single sat. Let that sink in. The best performing risk-adjusted asset in modern history, and Wall Street's collective response is to pretend it doesn't exist. It's like discovering fire and deciding, nah, I'm good with rubbing sticks together. What gives? Here's where it gets juicy. The people managing most of America's money, we're talking pension funds, 401ks, retirement accounts, are mostly dudes in their late 50s and 60s. These guys entered finance in the 80s and 90s when interest rates were falling for 40 years straight. They watched bonds print money like clockwork, saw the 60-40 portfolio work like magic, and built their entire worldview around that reality. Then Bitcoin shows up like a wrecking ball made of math and cryptography, and their brains short-circuit. It's not that they're dumb, it's that they've got a bad case of recency bias. That's psychology speak for what worked yesterday must work tomorrow. Spoiler alert, it doesn't. But wait, there's more. And this is the kicker that nobody talks about. These financial advisors, their number one job isn't making you rich, it's keeping their job. Recommending Bitcoin feels risky to them not because it is risky, but because explaining a 30% drawdown to Gertrude who's about to retire sounds like a nightmare. So they play it safe, stick with what they know, and call it a day. A 2025 study from the CFA Institute found that only 15% of financial advisors said they actually understand Bitcoin. 15%. And 55% admitted their lack of knowledge was the main reason they won't recommend it. Translation: I don't get it, so it must be dangerous. That's like a doctor refusing to prescribe antibiotics because they're too lazy to learn about germs. Now here's where Bitcoin's risk becomes the ultimate mind-bender. Bitcoin has a fixed supply, 21 million coins forever. No central bank can print more, No government can inflate it away. It's digital scarcity, which traditional finance has never seen before. And this causes extreme volatility because when demand changes, price is the only thing that can adjust. You can't just issue more Bitcoin to meet demand like you can with stocks or bonds. Supply is locked. Demand swings like a pendulum. Price goes bonkers. Wall Street sees that volatility and screams, "Risk! Danger! Run away!" But here's the plot twist they're missing. There's another metric called the Sortino ratio. It's like the Sharpe ratio's cooler, smarter cousin. Instead of penalizing all volatility, it only counts downside volatility as risk. Because let's be real, who cares if your investment is volatile to the upside? Nobody's complaining about making too much money too fast. Bitcoin's Sortino ratio, over 3 times better than the S&P 500. 3 times. Because most of Bitcoin's wildness is to the upside. It's not that Bitcoin is riskier, it's that Bitcoin moves faster in the direction you actually want. But here's the absolute nuclear truth bomb that's going to blow your mind. That risk-free rate Wall Street uses in all their calculations, it's not risk-free anymore, not even close. For 50 years, the U.S. 10-year Treasury bond was the gold standard of safety. Park your money, earn steady interest, sleep like a baby. But since 2022, the game changed. Interest rates shot up initially, but by late 2025, they've stabilized around 4.2%, while inflation has cooled to about 2.5%. Still, that safe return on bonds can get nibbled away if inflation ticks up again. You're not losing as dramatically, but the illusion of total safety is cracked. Think about it like this. Imagine a family maxing out credit cards to pay off other credit cards, while running a money printer in the basement for everything else. Sounds insane, right? That's literally what the US government is doing. The debt pile is so massive they can't pay it off. So they issue new bonds to pay old bonds, print dollars to cover the gap, and hope nobody notices they're paying you back in monopoly money that's worth less every year. This is called a debt spiral. More debt leads to higher interest rates, which leads to more debt, which leads to higher rates. It's a feedback loop that doesn't stop until trust collapses. Picture a snowball rolling down a mountain. Harmless at first, but every rotation adds mass and speed until it's not a snowball anymore. It's an avalanche that flattens everything in its path. And guess what? The world is waking up. Foreign countries held 56% of U.S. debt in 2008. As of mid-2025, it's down to about 29%. China, Turkey, and emerging markets are dumping U.S. bonds and buying gold, like it's going out of style. Gold's share of global reserves jumped from 6% to 14% since 2008. They're screaming, "We don't trust your printer," and running for the exits. But here's what they haven't figured out yet, and this is where you get ahead of the curve. Bitcoin is gold 2.0. It's everything gold does, but better. Digital, divisible, portable, verifiable, and absolutely scarce. No mining company can suddenly find more Bitcoin in the ground. No government can confiscate it without your keys. It's the ultimate neutral reserve asset, and it's coming for bonds lunch money. If you're sitting there thinking, okay, but what does this mean for my portfolio? Drop a comment below. What's the one thing stopping you from taking Bitcoin seriously? Here's a fun mental exercise that'll make your head spin. If we replace the so-called risk-free rate in the Sharpe ratio with Bitcoin instead of bonds, the math gets wild. Bonds and stocks start showing negative risk-adjusted returns. You read that right. Owning zero Bitcoin becomes the riskier position. Not because other assets are trash, but because they're not paying you enough to compensate for not owning Bitcoin. The opportunity cost is crushing. This isn't theory, it's math. And as this reality sets in, that 2% Bitcoin allocation recommendation, it's going way, way higher. Traditional finance will be dragged kicking and screaming into this new world because the numbers don't lie. Bonds aren't as safe as they used to be. Deficits matter. Government debt matters. The frameworks built over the last 50 years are breaking in real time. And the beautiful part, almost nobody sees it yet. Bitcoin is still in the early innings of adoption. Less than 0.5% of global assets are allocated to Bitcoin. We're living through one of the biggest mispricings in financial history, and you have a front row seat. Most people still think volatility equals risk. They see Bitcoin swing 20% in a week and run for the hills. But that's not risk. That's just what happens when absolute digital scarcity crashes into a global monetary system that nobody understands. Bitcoin isn't chasing pennies. It's chasing hundreds of trillions sitting in weaker assets. And when that capital realizes bonds are burning slowly and Bitcoin is the lifeboat, the returns will make today's volatility look like a warm-up. But let's keep it real. Bitcoin isn't for everyone. Yes, not everyone likes roller coasters. Some people genuinely can't stomach watching their portfolio drop 30% even if they know it'll come back stronger. And that's okay. The key is understanding how Bitcoin works and why it's secure, decentralized, and fundamentally different from everything else. Learn the fundamentals. Understand why 21 million is hard-coded. Grasp why proof of work matters. Get why self-custody beats trusting institutions. Because here's the truth. Bitcoin is far less risky than most people think. The real risk is staying stuck in the old playbook while the game changes around you. The real risk is trusting risk-free assets that are quietly draining your wealth. The real risk is waiting too long while everyone else figures it out. So, here's your homework. Take the time, do the research. Learn why Bitcoin's risk-adjusted returns destroy everything else. And position yourself to benefit while the opportunity is still massive. If this video opened your eyes even a little bit, do me a favor. Smash that like button so more people see this. Subscribe if you want more no BS Bitcoin content that cuts through the noise. Hit the bell so you never miss a video. Share this with anyone still sleeping on Bitcoin. And drop a comment with your biggest Bitcoin question or hottest take. I want to hear what you're thinking. Because at the end of the day, we're all trying to build wealth, protect our future, and not get wrecked by a system that's rigged against us. Bitcoin gives you a fighting chance. Don't blow it by misunderstanding the risk. I'll catch you in the next one. Stay sharp out there.